Let's take a few minutes to consider the approach we should take to preparing the statement of cash flows. You'll see it's a bit more complicated than the balance sheet and the income statement. This slide presents a summary of the components of a statement of cash flows. You can see the operating, investing, and financing sections are on the statement. There is also a cash reconciliation at the bottom of the statement that reconciles the change in cash with the company's beginning and ending cash balances. The ending cash balance on the statement of cash flows should always equal the cash balance on the balance sheet. And here we see a statement of cash flows prepared using the indirect method of reconciling net income to cash flows from operating activities. We will be covering this method in our next video. For now, you should know that preparing a statement of cash flows involves 5 steps. First, we compute the net increase or decrease in cash during the period. Second, we compute and report net cash provided or used by operating activities. Third, we compute and report net cash provided or used by investing activities. Fourth, we compute and report net cash provided by or used by financing activities. And finally, fifth, we compute the net cash flow by combining net cash provided or used by operating, investing, and financing activities, and then we prove it by adding it to the beginning cash balance to show that it equals the ending cash balance. These cash balances come from the balance sheet. As you saw a moment ago, computing the net increase or net decrease in cash is a simple but crucial computation. It equals the current period's cash balance minus the prior period's cash balance. This is the bottom line figure for the statement of cash flows and is an important check on accuracy. However, preparing the statement of cash flows from an analysis of the general ledger cash account has 2 limitations. First, most companies have many individual cash receipts and payments, making it difficult, if not impossible, to review them all. Secondly, the cash account does not usually carry an adequate description of each cash transaction, making assignment of all cash transactions according to activity very difficult. There's an easier way, which is to analyze the transactions in all the non-cash balance sheet accounts. A second easier approach to preparing the statement of cash flows is analyzing non-cash accounts. This approach uses the fact that when a company records cash inflows and outflows with debits and credits to the cash account, non-cash accounts are also affected. This is double entry accounting and the accounting equation in action. Assets must equal liabilities plus equity. Many of these non-cash accounts are balance sheet accounts, for instance, from the sale of land for cash. Others are revenue and expense accounts that are closed to equity. For instance, the sale of services for cash yields a credit to services revenue that is closed to retained earnings for a corporation. At the end of the day, all cash transactions eventually affect non-cash balance sheet accounts. Thus, we can determine cash inflows and outflows by analyzing the changes in non-cash balance sheet accounts. In summary, we compute the change in cash, analyze non-cash balance sheet accounts to determine which transactions caused the change in cash during the period. Then we organize those transactions into operating, investing, and financing activities. Information to prepare the statement of cash flows usually comes from 3 sources. First, comparative balance sheets, from which we can determine the change in cash and all other balance sheet accounts. The current income statement, from which we can determine net income, depreciation, and any gains and losses, and additional information if needed about investing and financing activities. Comparative balance sheets are used to compute changes in non-cash accounts from the beginning to the end of the period. The current income statement is used to help compute cash flows from operating activities, and additional information often includes details on transactions and events that help explain both the cash flows and non-cash investing and financing activities. See you in the next video.